My name is Matt Secrist. I'm an employee benefits partner at Taft. I focus on basically how people get paid. So I deal with 401k plans for companies, health insurance that's offered to employees, stock options, equity grants, obviously. So basically anything that how you want to pay your employees, sort of the person you can just ask those legal questions to, and happy to respond. So as the attorney here, I'm just going to kind of go over just a brief high level of the types of incentive equity. There's a lot more different types of incentive equity than what we're covering today, but I just wanted to cover a couple items from a high level. So we're going to talk about the two different types of stock option plans, or two types of different stock options that can be granted. And we're also going to be talking about restricted stock. So in the US, there's generally two types of options that we have listed out here. One is a non-qualified stock option, and the other one is an incentive stock option. Incentive stock options are, you might hear the term ISOs or statutory options or qualified stock options. They're all the same thing. They're all incentive stock options. It just goes by a lot of different names, okay? And then we're going to talk about restricted stock at the end. So let's start with non-qualified stock options. These are by far the most flexible type of stock options. They can be granted to employees and non-employees, such as consultants. So if you've got board members, for example, individuals that are just sitting on a board, they're not truly employees, you can grant non-qualified options to them. What you're going to find in the same case as an ISO, incentive stock option, there's no immediate tax on the grant. So you grant this option to purchase shares of the company for an exercise price. And on that grant date, there's no tax impact. There's zero tax impact at all to both the employee and the employer. Then later on, say you granted the option for an exercise price of $5. You met all your vesting criteria, it's exercisable, now that stock is worth $10. That employee can exercise that option and pay $5 and receive shares that are worth $10. Now, when they exercise it, the difference between the fair market value on the date of exercise minus the exercise price is considered wages. That's subject to income and employment taxes. From an employee perspective, that's wages that's reported in your W-2, and your employer will withhold on it and pay the Social Security and Medicare taxes. Both the employer will pay its share and the employee will have its share withheld during the exercise. If you're a self-employed person, such as a board member, you'll get a 1099, and then you'll be responsible for all of your employment taxes and income tax withholding. Because in the US, generally speaking, employers only withhold for employees. They don't withhold for 1099 consultants like board members. Now, on the exercise, that difference between that's included as the wage piece, the employer can claim a tax deduction for that. So that's a benefit for employers with non-qualified options. Now, the key with non-qualified options is in the US, we have Internal Revenue Code Section 409A. 409A governs non-qualified deferred compensation programs. So that's basically when you have a right to compensation one year, but you don't receive it until a later year. Generally, options comply with 409A if you have the exercise price on the date of grant being at least equal to the fair market value of the shares on the date of grant. Now, a lot of companies are like, how do I set the exercise price? Well, the IRS and the Treasury regulations have a set of rules as far as the factors that you need to consider. Now, a lot of companies, especially startups, we're not financial experts. We're not valuation experts. So the conservative route to do is to hire a valuation consultant to determine the fair market value. Now, this is a key point. I want to emphasize the 409A compliance, because if you get this wrong, this is where that tax bill comes. So unlike other tax code provisions where, okay, you mess up as an employer, so the employer has to pay a penalty. Under 409A, the penalty is actually against the option holder, the optionee, the participant. The penalty is actually 20% of the amount. It's an excise tax of 20% of the income of the deferred income piece, the value between the exercise price and the fair market value of the shares. And the employee also has to pay interest penalties. This can be sort of the messy situation. You're well intended to incentivize employees, but if you don't follow these rules, not only they're including money amounts in their income before the wage piece, they're also having an extra tax bill on top of it. So it's kind of a double whammy that they want to avoid. I have a little example here on this slide. I won't go over the whole thing, but basically I go over year one with the exercise price of 10, similar to like I talked about. Year three, fair market value of 50. When they exercise the option for $50 a share, and in year five when they sell those shares for $10 a share. Again, the option is not taxed on grant. When exercised, the consultant has $400 of income. That's considered wages. That's the $500 minus the $100. The employer can claim a tax deduction for that. And then when the employee later sells the shares that they acquired, because then when they exercise, they actually have shares. They're a shareholder. They're an owner of the company. When they sell those shares, if they hold the shares for at least a year, then any gain between what the fair market value and exercise and what they sell it for, so $500 in this case, is subject to long-term capital gains tax. And that's a lower tax rate than your ordinary income tax rate in the US. So NSOs are again, the most flexible. The other side are what's called incentive stock options. You don't see this too much in the startup world. You see it a little bit. The reason I don't say you see it that much is because it's a little more complicated. There's a lot more bells. There's a lot more regulation versus NSOs. So incentive stock options, number one, they can only be granted to employees. So you can't grant your incentive stock options to your vendor or your consultant or your board member unless that person happens to be an employee. If they're a 1099 consultant or not a W-2 employee, they can't be granted ISOs. Similar to an NSO, there's no tax on grant. What's the key feature with an ISO is that when the person exercises it, there's no income tax recognition at that point either, generally speaking. And the employer cannot claim a tax deduction for any difference between the fair market value on the date of exercise minus the exercise price. There used to be in the US consideration for the alternative minimum tax. So employees, when they exercise ISOs, they might have to include some of the value for calculating their alternative minimum tax. But a few years back, we had tax reform. And tax reform really changed the alternative minimum tax rules. So it's less likely that an employee that's granted ISO will run into these rules, but it's always good for that employee to go talk to their tax advisor to see if the exercise in ISO is going to trigger the AMT rules. Now, if the holding period is met, we'll go over what the holding period means in a minute, then the employee is subject to capital gain tax when the shares are sold. There's no income and there's no wage piece, so there's no Social Security and Medicare taxes if you meet all the holding period rules. So just taking a step back again, when you exercise an ISO, unlike an NSO, there's no tax recognition at that time. And then if you later sell it, you're going to be subject to the capital gains tax rate if you meet the holding period rules, and you won't be subject to the employment tax rules. Now, the holding period, this is really key. This takes some tracking here by the employer. The holding period is met when the shares acquired and exercised are held by the employee for both 2 years from the date of grant and 1 year from the date of exercise. Now, if you don't meet the holding period, say the employee sells the shares in the same year that they exercise the shares and receive the shares through the option, then the difference between the fair market value of the shares on exercise minus the exercise price is considered compensation income to the employee. Now, the employer is not required to withhold on the compensation income, and the employer may claim a tax deduction on this compensation piece. Now, when the employee sells the shares, if there's any gain above the fair market value on the shares on the date of exercise, that gain will be subject to either short or long-term capital gains tax, depending how long the employee held the shares. I have a couple examples here in the next couple slides. So this slide talks about when the holding period is met. Here's an example. In year one, the employee is granted ISOs to acquire 10 shares with an exercise price of $10 a share. In year three, they exercise it when the share price is $50. And then in year 5, after holding the shares for the remaining of year 3, all of year 4, and then whatever period of year 5, the employee sells the shares for $100 a share. Again, the option is not taxed on the grant date. Now, when the option is exercised, there's no federal tax event. Again, just note that alternative minimum tax rules that I mentioned before, it's not likely that they're going to be triggered because of tax reform, but still the employee should consider that in case they are subject to the AMT rules. And the employer cannot claim a deduction. Now, when the shares are later sold, the employee has income of $900. So you take $1,000, that's your 10 shares times $100 a share, the fair market value on sale date, minus $100, the exercise price. And that will be long-term capital gains for the employee. And that's a much lower tax rate than your ordinary income tax rate. Plus, you don't have employment tax consideration too. Here's an example. Here's the flip side of the example when you don't meet the holding period. This one, same kind of example, except the employee is selling the shares in the same year that they exercise the option. Again, no tax on the grant date, no tax on exercise. But since the holding period isn't met, the employee recognizes compensation income of $400. That's $500 minus the $100. And the employee also recognizes income of $500 for the later sale of the shares. Now, that would be a short-term capital gains because those shares haven't been held for a full year. And the employer may claim a tax deduction for the $400. So this kind of shows you the benefits of an ISO, but again, you've really got to track the holding period to make sure those periods are met. And aside from the holding period, there's a lot of other nuts and bolts that go with an incentive stock option. First of all, you got to get shareholder approval of the plan. The plan can only have a 10-year term. And if you got folks that are both owners and employees, if they're a 10% owner, you have to set your exercise price at 110% of the fair market value on the date of grant, and the option can only have a 5-year term. And also you got this funky $100,000 limitation on ISOs. So you look at the value of the ISOs in the date of grant, and if the value is above 100,000 on the date of grant, and if you look at the value data grant and when they become first exercisable, if you breach this $100,000 limit, then anything above this limit goes into non-qualified option treatment. You lose the ISO treatment for anything above the 100,000. So again, there's a lot of tracking with ISOs, and that's why I think more startups grant NSOs versus ISOs. The other type of equity grant I wanted to briefly talk about was restricted stock. Now, this is typically only granted to founders, and this is a real grant. You're getting a grant of shares that is subject to restrictions. Typically, it's a vesting schedule that sets forth like a service requirement. So you have to work 4 years. You vest 25% each year. That's what I typically see. You also see restricted stock grants that you have to meet some kind of performance condition. You have to help apply for a patent, or you have to reach certain sales goals in order to become vested. Now, what's key here with the restricted stock is typically when you grant restricted stock, the company has a lower value, and you still have that vesting condition that has to be met. So the employee really doesn't own anything until that vesting condition. They're not really they're a shareholder with restrictions. They can't vote. They usually can't receive dividends. So they don't really have any kind of the rights and features as a shareholder, as a full shareholder, until those vesting conditions are met. But the Internal Revenue Code allows for employees to make this Section 83B election. So that basically allows the employee to treat the full value of the grant as includable as income and on the grant date, even though the vesting hasn't happened. And employees will do that because they're recognizing a lower value. And then when they recognize that lower value, say they meet the vesting conditions and later sell the shares, the triggering point for how long you've held the shares for whether you're a long-term capital gains, subject to long-term capital gains, is triggered when you make that 83B election. So you make the 83B election year 1, and then by year 4, you're fully vested and you sell the shares. Because you've held the shares for longer than 1 year since you made that 83B election, you will be subject to long-term capital gains on any gains over the amount you brought into income. The downside on that is that, say if you leave the company, again, you're making a tax position. You don't really own the shares yet. So the risk is on the employee when they make that 83B election. So if they leave later on and they're not fully vested, then they've really kind of lost out on all that, what they brought into income and pay taxes on. There are rules that allow employees to make what's called a claim of rights position on their tax return, so they can get a credit for bringing amounts into income that they ended up not having a right to. That's more of a personal income tax situation, but for the most part, they're kind of out of luck if they make this 83B and they don't meet their vesting condition. And the last, I just want to make sure I mention, this is frequently missed with equity grants. Equity grants it's a grant of security. It's a right to own, it's ownership interest in the company. Generally speaking, from a federal level, grants under incentive equity plans are exempt from securities registration from a federal level, but there are state laws that still could apply. For example, California, if you grant equity to an employee in California, you are exempt from registering that security, but you have to give notice and meet certain plan term requirements to the California authorities. And the same with New York. New York requires a registration or approval process before you can grant any kind of equity to employees.